Hey everyone, it's Financial Freedom here. Today, we're diving into the top 5 monthly dividend ETFs to boost your passive income and fast-track your financial independence. These ETFs generate a steady stream of income without the weight of traditional quarterly payouts. But remember, not all ETFs are created equal. We'll unpack each ETF's strategy, strengths, and risks you need to understand before investing. By the end of this video, you'll know if these ETFs deserve a spot in your diversified portfolio. Let's kick things off with the Global X SuperDividend ETF, ticker symbol SDIV. This ETF offers a dividend yield that often exceeds 10% per year. SDIV invests in a basket of 100 companies worldwide known for high dividends. This global diversification helps spread your risk. But there's a reason why those yields are so high. Sometimes struggling companies offer massive dividends to attract investors. Those sky-high dividends might not always be sustainable. If a company's core business falters, the dividend could be the first to go. Your investment could take a hit in both income and share value. SDIV can be tempting, but you must be aware of the risks. Make sure you're comfortable with the volatility that comes with high-yield investments. Always do your due diligence on the underlying companies in the ETF. Are their businesses rock solid, or are those dividends built on shaky ground? That's the question you need to answer. If the global aspect of SDIV has you hesitant, maybe its American cousin, the Global X SuperDividend U.S. ETF, ticker symbol DV, will be more your speed. This ETF is designed for those who prefer to keep their investments closer to home, focusing solely on U.S.-listed companies. This ETF focuses exclusively on U.S.-listed companies, 50 of them known for their dividend-paying prowess. These companies span various sectors, offering a diversified approach within the U.S. market. Think of DIV as a more conservative version of SDIV. It's tailored for investors who seek stability and are wary of the volatility that comes with international markets. It aims to deliver monthly income with less volatility. This makes it an appealing option for those who prioritize steady income over high-risk, high-reward scenarios. The yield is typically in the 5 to 6% range. While this might not be as high as some other options, it offers a balance between risk and reward. One big advantage of DIV is dealing with a more transparent and regulated market. The U.S. financial system is known for its stringent regulations, which can provide an added layer of security for investors. Plus, DIV uses an equal weighting strategy, preventing overconcentration in any single stock. This means that no single company can disproportionately affect the ETF's performance. This can be a lifesaver if one of those companies hits a rough patch. By spreading the risk evenly, DIV aims to provide a smoother investment experience. But focusing solely on U.S. companies means you're putting all your eggs in one basket. This can be a double-edged sword. If the U.S. economy takes a downturn, your portfolio could feel the heat. Economic cycles and market conditions in the U.S. will directly impact your investment. The yield is attractive but not as high as SDIV. If you're looking for higher returns, you might need to consider the global option. If you're chasing double-digit yields, DIV might not be the right fit. It's designed for those who are content with moderate, consistent returns. Whether DIV is a good choice depends on your risk tolerance and investment goals. It's crucial to align your investment strategy with your financial objectives. If you're looking for a relatively stable way to generate monthly income from U.S. companies, DIV could be worth a closer look. It offers a way to tap into the reliable dividend payments of established American companies. But if you're looking for maximum yield and are comfortable with more risk, you might want to stick with its global counterpart. The choice ultimately depends on your individual financial situation and investment philosophy. If you prioritize sleeping well at night over chasing the highest yield, then you might want to consider a more conservative investment approach. The Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD, might be for you. This ETF is designed for those who value stability and consistent returns over high-risk, high-reward strategies. This ETF finds a balance between generating income and protecting your investment. It aims to provide a steady income stream while minimizing the risk associated with market volatility. It tracks 50 stocks from the S&P 500 that pay out solid dividends and have low volatility. These are companies that have a history of financial stability and reliable performance. We're talking about established, blue-chip companies with strong financials. These are household names that have stood the test of time and continue to perform well. SPHD is the responsible older sibling of the ETF world. It's the kind of investment that offers peace of mind, knowing that your money is in safe hands. It's not going to wow you with flashy returns, but it's reliable during market downturns. When the market gets rough, SPHD tends to hold its ground better than more aggressive investments. The yield is typically in the 3 to 3.5% range. This steady return can be particularly appealing for those who are looking for predictable income. SPHD is about providing a reliable income stream while minimizing risk. It's designed to offer a sense of security, especially for those who are in or nearing retirement. For risk-averse investors or those nearing retirement, that's a trade-off worth making. The focus here is on preserving capital and ensuring a steady flow of income. If you're looking for an ETF focused on capital preservation and steady income, SPHD is worth considering. It's a solid choice for those who prefer a more conservative investment strategy. It's not about maximizing yield at all costs, it's about reliability. With SPHD, you can rest easy knowing that your investment is designed to weather the ups and downs of the market. Let's talk about a different kind of income-generating asset preferred stocks. The iShares Preferred and Income Securities ETF, ticker symbol PFF, reigns supreme in this space. Preferred stocks are a hybrid between stocks and bonds, offering higher yields and some bond-like characteristics. PFF invests in a diversified basket of preferred stocks, yielding around 5 to 7%. Preferred stocks often behave more like fixed income investments, adding stability to your portfolio, but they are sensitive to interest rate changes. When interest rates rise, the value of preferred stocks tends to fall. PFF is heavily concentrated in the financial sector, as banks are the biggest issuers of preferred stocks. If the financial sector takes a hit, PFF will feel it. PFF can add diversification and income to your portfolio. Just be aware of the interest rate risk and sector concentration. Make sure you're comfortable with these risks before investing. If you like preferred stocks but want to keep things closer to home, the Invesco Preferred ETF, ticker symbol PGX, might be for you. This ETF is designed to offer investors a way to gain exposure to U.S. preferred stocks, which can be an attractive option for those seeking income and stability. Preferred stocks are a unique asset class that combines features of both stocks and bonds, offering fixed dividends and priority over common stocks in the event of a company's liquidation. This ETF focuses exclusively on U.S. preferred stocks, providing a targeted approach for investors who want to concentrate their investments within the United States. By focusing on U.S. preferred stocks, PGX aims to deliver a steady stream of income while potentially offering some capital appreciation. PGX offers a yield typically in the 5 to 6% range, which can be quite appealing in a low interest rate environment. This yield is generated from the dividends paid by the preferred stocks held within the ETF, making it a potentially attractive option for income-focused investors. Managed by Invesco, a well-respected name in the ETF space, your investment is in good hands. Invesco has a long history of managing ETFs and a strong reputation for delivering quality investment products. Their expertise and experience in the field provide an added layer of confidence for investors. PGX has a straightforward portfolio structure focusing on U.S. preferred stocks. This simplicity can be a benefit for investors who prefer a more transparent and easy-to-understand investment approach. The ETF's holdings are primarily concentrated in the financial sector, which is a common characteristic of preferred stock ETFs. It's large and liquid, making it easy to buy and sell shares. Liquidity is an important factor to consider when investing in ETFs, as it ensures that you can enter and exit positions without significant price impact. PGX's size and liquidity make it a convenient option for both individual and institutional investors. However, PGX shares the same risks as PFF. One of the primary risks associated with preferred stocks is their sensitivity to interest rate changes. When interest rates rise, the value of preferred stocks can decline, which can negatively impact the ETF's performance. It's sensitive to interest rate changes and heavily concentrated in the financial sector. This concentration can lead to increased volatility and risk, especially during periods of financial market stress. Investors should be aware of these risks and consider how they align with their investment objectives and risk tolerance. PGX is less diversified than PFF, missing out on global diversification benefits. While PGX focuses solely on U.S. preferred stocks, PFF includes a broader range of preferred stocks from around the world, providing additional diversification and potentially reducing risk. Whether PGX is a good fit depends on your circumstances and risk tolerance. It's important to evaluate your own financial situation, investment goals, and risk appetite before making a decision. Consulting with a financial advisor can also provide valuable insights and help you determine if PGX aligns with your investment strategy. If you're looking for a high-yielding way to add income and are comfortable with the risks, PGX could be worth considering. The ETF's focus on U.S. preferred stocks and its attractive yield make it a compelling option for income-seeking investors who are willing to accept the associated risks. But if you want maximum diversification or are concerned about interest rate risk, you might want to stick with PFF or explore other options. Diversification is a key principle of investing, and having exposure to a broader range of assets can help mitigate risk. Make sure you're comfortable with these risks before investing. Understanding the potential downsides and how they fit into your overall investment strategy is crucial for making informed decisions. So there you have it, 5 powerful monthly dividend ETFs to help you unlock financial freedom. These ETFs offer a way to build a consistent income stream without waiting for quarterly payouts. But no single investment strategy is one size fits all. Each ETF has its own mix of yield, risk, and volatility. Do your homework and understand each ETF's strategy, expense ratio, and potential risks. If you're unsure, consult a financial advisor to create a personalized plan that aligns with your goals.